Good morning, good afternoon to those of you on the East Coast. Thank you for joining us today for part 2 of our Ask the Expert series around the new lease accounting standard. My name is Todd Follett. I'm a managing director in the Dallas office, and with me is Neil McDonald. Neil's a senior manager and one of our leasing experts. Neil's also from the Dallas office.
Good morning.
So we're utilizing Zoom today to broadcast this webinar. We hope that you're dialed into the Zoom app from a desktop or laptop device. That's going to provide you the opportunity to view the slides that accompany the presentation, as well as ask questions and answer polling questions. When you register for this webinar series, you're provided the opportunity to ask a question. Our team gathered those questions and we plan to address them throughout the series. So if you don't hear your answer today, it's probably fits better in a future series or a future part of the series. However, if additional questions arise during this presentation, we'd invite you to hit the Q&A button at the bottom of your screen, which will pop up a window and allow you to submit a question in real time. We have someone monitoring those questions and we'll try and address as many as possible in the time allowed today. Finally, remember that we will be providing the opportunity to earn CPE for attending today's webinar. To qualify for 1 CPE credit hour, you must answer 4 of the 5 polling questions and be present for 50 of the 60-minute presentation. So as stated earlier, this is part 2 of a 5-part webinar series. The dates and times of part 3 through 5 are listed in the presentation, if not already on your calendar invite. As you'll notice, each part is focused on digging into more detail on various aspects of adopting the new standard, and each part offers 1 hour CPE. For those in attendance who missed part 1 on the practical expedience, we'll share all 5 parts on our Riveron website at the conclusion of the series. If you absolutely can't wait that long, please reach out directly to our Sears coordinator and we can get you connected to the replay link sooner. Please be aware that the webinar replays are not eligible for CPE credit. You have to attend live. So now that we're done with the administrative items, let's dive in. We want to start with a polling question to understand where everyone is in this process. So the polling question is, what progress has your company made in adopting ASC 842? A, assessing the key impacts of ASC 842 on your lease portfolio. B, extracting lease data from upstream systems, databases, or contract information. C, implementing lease accounting systems and business-related processes. Or D, have not started or in the preliminary stages of adopting ASC 842. The focus of today's webinar is what happens on day 1 and thereafter when you live in an 842 world. And I'd assume that most people are somewhat familiar with the new standard, but just to be sure, let's take a quick step back and look at what actually happens on day 1 of adoption. For leases that were historically accounted for as capital leases, there's effectively no significant change at the transition date. The leased asset and lease liability remain on the books as before, but now they're called finance leases. Operating leases will have a more significant change. At the date of transition, future lease payments are discounted back to the transition date using an appropriate discount rate for leases with original terms greater than 12 months. That value creates a lease liability that goes on the balance sheet, similar to finance leases. In addition, the right of use asset is placed on the books to represent the company's right to use the leased asset. We'll talk a little more detail in a minute about exactly what comprises the right of use asset at the transition date. So in terms of where we are in the polling questions, it looks like it's, the good news is it looks like a lot of people have started. We do have some that have not started, but pretty good dispersion around where everyone is in the process. Okay, so we wanted to start by reviewing what we believe are some of the common challenges in adopting the new standard that we've observed. The first challenge to getting to day 1 is your completeness assessment. We're seeing that auditors are very interested in the process that companies go through to confirm completeness and accuracy of their lease portfolio. Simply tying out to the prior year 5-year commitment table isn't going to be enough. There needs to be a holistic scrub of payments and a documented inquiry process that provides evidence of how management became comfortable that all the leases were identified. So when Riveron's engaged to do this, the output is both a quantitative data book of past payments, where we look for recurring payments or payments with certain key words in the name, as well as a qualitative documentation of contract reviews, internal management reviews, and sometimes even external reviews with significant vendors. Addie talked through the practical expedience available in the standard in part 1 of the series. The choices that you make regarding these practical expedients will have a significant impact on the amount of work required to determine and reconcile this day one gross up entry. For example, the volume of leases that you need to abstract to quantify in your balance sheet can be significantly impacted by your elections related to short-term leases and land easements at transition. As you recall, the practical expedient provides companies the option to not include these leases on the balance sheet at transition. However, some clients have made business decisions to include certain leases in an effort to maintain a single accounting and business process for their complete lease portfolio. If this is you, just be aware that that decision requires a lot more time to gather, load, and reconcile the data related to those leases. You also have to decide what tools you want to use to calculate and manage the lease balances on a month-to-month basis. I'll support what Addie mentioned in part one of the series, that you can do all of this in Excel, but once you get over approximately 50 leases, we found that the workload and complexity of managing all the activity really starts to put a strain both on the Excel model as well as the technical accounting subject matter expert that has to make determinations of the accounting impacts of all the events. Because of this, most people with anything greater than about 50 leases are choosing to use one of the lease management tools that are out in the market. The best-in-class tools will manage all the accounting, disclosures, and workflow that most companies will need to operate successfully under the new standard. So it can be as simple as configure the system, reconcile periodically, and load journal entries at the end of every month. However, even with a system, companies will need to consider how they want the system to interact with their other existing systems. So as an example, we've seen clients retain finance lease assets in their fixed asset system to maintain current robust management reporting processes and supplement other financial information. In this example, we worked with the clients to create a set of clearing accounts and journal entry processes to accomplish this task. So it's important to determine if you need a tool, but it's equally important to start thinking about how you want to use that tool in conjunction with other systems and processes. Neil, have you seen any other situations where a company's taken a hybrid approach at accounting for leases under the new standard?
Yeah, well, the continued management of capital leases in the fixed asset system definitely seems to be the most common hybrid approach to accounting for leases with a lease software. The other that comes to mind are businesses that are unwilling to interfere with robust AP payment processes. If the AP module books a cash basis journal entry for cash and expense, then the lease system journal entries have to be manipulated to post an adjustment to straight line expense to comply with the requirements of the new standard. We've seen this several times in oil and gas where, joint interest billing accounting requires cash basis entries at the project level. Companies don't want to monkey with this process, so we create workarounds from the traditional accounting journal entry structure. So in this example, we book the straight line rent entry above the project level. And this is to meet the requirements of the standard without upending an existing business process.
Yeah, that's a good point. Another big challenge is reconciling your final GL balances to supporting detail. So once you've gone through the process to abstract all the data elements from the leases into some sort of structured tool, you're going to need to map all those balances and activity to the correct account lines, departments, cost centers, etc. within your organization. So once you ultimately load the activity in the GL, you're going to want to carve out some time to reconcile the ending balances at various levels of detail to ensure that not only the balances are correct, but they're being recorded at the correct segment and functional level. Obviously, mistakes are made when you're talking about large data abstraction projects. And so you need to make sure that you take some time to anticipate that and work through those challenges. So finally, you'll likely run into a challenge of identifying and addressing differences between your 840 GL balances and your 842 transition entries. We're going to talk a little bit more about this in a minute. So on this next slide, we wanted to address a common question that we received from clients as we talk them through transition. The question comes in various forms, but essentially the question is centered around what's the journal answer on day one for operating leases and how does that work? So what we've done here is construct a slide with a pretty basic example to explain what's happening. Let me start by saying that if you're accounting for operating leases correctly under ASC 840 and you elect the package of 3 practical expedient, which says you don't have to reevaluate leases, and you also don't elect to use hindsight, then the entry at the transition date should be a simple balance sheet gross up along with a reclass of existing 840 straight line rent balances. We would not expect a retained earnings impact in this scenario. So let me walk you through how this works. What I'm showing on this slide is a snapshot of a lease that straddles the adoption date of ASC 842. It started in December 2017 and runs through November 2020. So for simplicity in this presentation, I'm not showing all periods, just a few months before and after transition date to show how the entries will work. The first row in the example shows a beginning deferred rent balance. Again, if I were to show every month of the lease, you could see the monthly entries that build up that balance, but you're just going to have to trust that it's correct. So then the next three rows show the debits and credits associated with payments on that lease. So in October and November, the monthly lease payments are $10,000, and in December, the lease reaches an anniversary date and the monthly rent escalates to $10,500. And because we're all good accountants and understand that operating leases under ASC 840 require straight line expense recognition, we built a straight line rent schedule at the beginning of the lease and have been recognizing the straight line expense of $11,000 on a monthly basis since lease inception. The difference between the cash payments and straight line expense is hung up in deferred rent at each period end. So on the transition date, the deferred rent balance is $12,500. It should be a simple kind of run through and reminder of how it works under the old standard. So what happens to this balance at transition? The answer is that it gets collapsed against the right of use asset. And why that works is actually pretty simple. Similar to ASC 840, ASC 842 requires straight line expense recognition for operating leases. In order to accomplish this with leases that have escalating payments, you'll need to post an entry to the balance sheet for the difference between the cash payment and the straight line expense. The only difference is that in ASC 842, this entry nets against the right of use asset model. You'll notice that the far two right columns, the right of use asset and right of use liability, are not the same number. Again, this is because at the time of transition, we're 1 year into the lease, and the difference between the cash payments and the straight line rent payments for the first 12 months are netting down the right of use asset account. So how do you record this entry? You flip out the balance in deferred rent to eliminate the legacy deferred rent account balance in your general ledger. So this debits the deferred rent balance on your balances your transition entry and zeroes out the legacy account that will no longer be used. The concept's the same for lease incentives and initial direct costs that you might have on your balance sheet. These cash flows should be included in the determination of your right of use asset and liability in abstraction, so that at transition, you can record a balance journal entry to post the right of use asset and liability at the correct value, as well as zero out all the legacy account, balance sheet accounts to arrive at a straight line rent under ASC 840. So you can see in the second bullet at the bottom of this slide, similar wording found in most implementation guides. And that is that the right of use asset is equal to the liability plus or minus the balances of prepaid or deferred rent, lease incentives, and IDCs. So this isn't new news, but we typically find it helpful to actually show this walk. Once we walk clients through this example, they generally have a much better appreciation for how this works. So after transition, you can see that the straight line rent amount is the same as before, with monthly P&L entries similar to 840, but the additional entries to reduce right of use asset and liability over the remaining lease term. So that's the basics of how the transition entry works. So let's pause now for our second polling question. So which of the following services do you anticipate utilizing implementation partners for in the adoption of the new standard? A, assessment and technical advisory work. B, system implementation. C, data abstraction. D, a combination of the above service offerings. Or E, I'm not planning on using an implementation partner. Neil, what have your experiences been in assessing day one transactions as an implementation partner?
Yeah, operating leases really have been a significant day one focus. In Excel, this practice has been fairly easy, as you would maintain a workbook that would help present value future payments, create the liability and the right of use asset, and really any entries to carry forward IDCs, lease incentives, or deferred rent balances. There's just more formulaic visibility in the determination of the day one balances with Excel. However, most of the systems are designed to report on month-end balances, and really in the form of a hard-coded number through a report. So you have to almost remove the first month of activity to back into day one balances. We've designed tools to expedite this process by looking for entries at the transition date or looking for posting codes that are unique to transition date entries within the monthly accounting activity. It's just been more challenging than anticipated as the client, at the same time is absorbing the activity of unamortized 840 balances as well. This is just an important, point for clients as they try to tie back to SAB 74 and other disclosures that, they made regarding the impact of the new standard. And also, since, Todd is talking about day one transition entries, I just want to quickly note the GL design activity required in advance of booking your day one entry. As part of the adoption of ASC 842, companies will need to create at least a new GL account to track the capitalization of the right of use asset and lease obligation for these operating leases. But from there, the company has some flexibility in adding additional accounts like accumulated depreciation for operating leases, or alternatively, we have seen a number of clients that actually net the activity against the right of use asset account.
Thanks, Neil. All right, let's review our polling results. It looks like about 50% are planning on using a combination of service providers for a combination of different activities, and about a little over a quarter are planning on not using implementation partner at all and just kind of bootstrapping it themselves. So before we get off your point, Neil, I wanted to there's our results. Apologies. I wanted to make sure that we go back and you made a really good point about new accounts required, and I just wanted to make sure that people appreciate that some companies, it takes a long time to set up new accounts, and be thinking about that. Be thinking at the beginning of your project of what kind of new accounts do I want to open, what kind of accounts do I need to be able to manage all this activity, and if it takes a little while to get approval and set up for these accounts, put those early on in your process. So the example that we walked through typically helps to answer the first question of what are the journal entries, but it almost always is followed by a second reasonable question of what if closing out my legacy GL account balances doesn't balance my transition entries? We've had clients say, I'm just going to flush that through to retained earnings because that's what the guidance says. And I wanted to take a moment to address that that's only partially correct. What the guidance says is that you can make a cumulative effect adjustment to retained earnings on the transition date for differences arising from appropriately applying both standards. Now, it doesn't explicitly say this anywhere, but when you look through the guidance and all the implementation guides, the examples that record an entry to retained earnings on transition are all related to changes driven by appropriately applying both standards. And these differences are typically seen when companies do not elect the package of 3, which requires them to reassess classification as of the transition date and the lease flips from maybe an operating lease to finance lease, or when they elect to use hindsight and the lease term changes. There can obviously be other drivers, but those are the two big ones that we've seen. So for instance, if you elect to use hindsight and you determine that the reasonably certain holding period is longer under ASC 842 than it was previously, and the lease has rent escalations, your deferred rent balance is going to be different under the new standard than it was under the old standard. And the guidance says that this difference should be recorded as retained earnings as a cumulative effective adjustment to retained earnings. So what I'll tell you is that we aren't seeing a lot of differences similar to the example I just gave. And that's mostly because, as Addie mentioned earlier on part 1 of this webinar series, most of our clients are taking the easy road and electing the package of 3 and not electing hindsight. But we're still seeing differences, and clients are still asking, what do I do with those differences? Well, that's a more complicated answer. What we typically tell our clients is that you need to be prepared to explain what's driving the differences. And typically, it's not just one thing. Some examples to illustrate my point. Maybe you had a policy election to not record straight-line rent on leases to ease administrative burdens if the overall financial impact was deemed to be immaterial. Or maybe you're a highly decentralized company and some of your field accounting staff that were managing local leases out in the field didn't record straight-line rent. Or perhaps you misclassified as a lease as an operating lease and caught the error during your abstraction process and realized you need to account for it as a finance lease under 842. The answer is probably a combination of several different factors. So you should begin a process to track the individual drivers so that you can begin to figure out how to account for them on transition. If the difference starts to reach a material level, you should probably begin the process of structuring a SAB 99 analysis, as you're likely going to need to walk your auditors through your findings. And I'll tell you that practically what we've seen is that small errors that fall below materiality thresholds are differences that are a result of policy changes. So going back to my example where the prior policy was not the straight line rent for immaterial leases, those are being recorded retained earnings as a change caused by the new principle. Larger errors need to be addressed. You can't just blindly flush it through retained earnings, and it's not always appropriate to take the P&L charge in the last period before transition to get your balance sheet correct, because typically the error is accumulated over time, and it's just as wrong to blindly post an entry to the P&L when it affects all periods. But if you start to track the reasons for the differences in the financial statement impact to each historical period, it'll help you gain some clarity. And then you'll have to go back and you'll have to review the guidance in ASC 250 that discusses accounting changes and error corrections to determine how to proceed. When you've completed all of this, then I think you've got a pretty good framework for discussions with your auditors.
Yeah, one other topic I want to mention before we move on from day one transition entries. While technically you have time after the required adoption date to finish the transition if you need it, there are challenges in a late transition to the new standard and putting off day one adoption. We've seen this come up in a number of different cases where the client felt the timeline to transition extended really through the end of the first quarter before there was a need to report. In Todd's walk, he mentioned straight line expenses not changing. So in theory, we are only accounting for the new right of use asset and lease liability. So really the question is, why the urgency to adopt at the beginning of the period? There are a few things that really have put strain on these types of projects. One, we discussed the movement of deferred rent into the right of use asset. I would also mention here that as part of that, you are putting off GL reconciliation needs, and you potentially lose the flexibility to account for those differences in the prior fiscal year. And lastly, just the general strain on those adopting the new process as they tend to be disorganized and really lack sufficient training to navigate the new standard or a system if implemented late.
Okay, great. Let's move on to the next polling question. Which of the following selections best defines your business structure? A, public calendar year filer. B, public off calendar year filer. C, private. D, advisory firm. E, none of the above. So Neil, I think those are all real good points. The biggest lesson learned is that all those tasks related to locking down a day one number takes a lot more time than you think it should. So let's transition to day two. What we've observed through our experiences is that most companies have been on a mad dash to reach day one transition, and the level of effort and planning around day two and beyond has taken a back seat. So we wanted to take the rest of this time to talk about how to plan and action on day two and beyond. Before we move on, though, it looks like most of our polling results are in, so we are going to end the polling. And it looks like well over half are private clients, and so you've got a large amount of the work ahead of you, and so we're hopeful that this will be helpful for you. All right, so one of the major reasons why adoption of the new standard is so challenging is also a reason why maintenance of the new standard will be challenging. Leasing activity touches a number of areas within an organization. You have business unit operators that define business unit requirements for assets or services that can involve new arrangements, renewals, or modifications of existing agreements. Procurement may be involved to administer the acquisition process. Treasury manages payments. Various lessors are involved, and along with that, various contracting and payment methods, as well as various midterm and end-of-term options. And if you're big enough, we've even seen centralized lease accounting departments emerge to manage the administrative and financial requirements under the new standard. We're also listing AP and legal. I'm sure we've missed a few other involved parties at this point. But the point being is that managing a lease portfolio can be quite complex. So as a way to try and organize the conversation, we want to talk about these post-transition activities in three buckets: pre-close and event management, month-end close, and then disclosure reporting. So the first bucket by far involves the most participants. This is the time between reporting periods when all the activity occurs within your lease portfolio. This is when leases are added, modified, bought out, renewed, and assets within existing leases are added and returned. And as we stated, it involves a wide variety of participants. This is where companies need to think about existing business processes and required changes to business processes to ensure that all the leasing activity is captured and circulated to the appropriate parties to ensure the changes are accounted for correctly according to the new standard. In a highly decentralized organization, This requires significant planning and coordination. Another item I'd like to highlight here is payment reconciliation. Very few accounting systems are fully integrated in the general ledger, where actual payments are auto-reconciled to presumed payments in the lease accounting system. Instead, lease accounting systems are fed a series of payments when leases are initially loaded, either at transition or at the lease inception or the lease initiation for new leases. And the presumption from these systems is that these are the amounts that will be paid throughout the life of the lease. In actuality, many times lease payments change for a variety of reasons. So payments may be raised based on CPI, which was unknown at the start of the lease, or maybe the lease was amended to take on another floor of a building or partial floor of a building. So regardless of the reasons, actual payments must be reconciled with presumed payments, and the differences have to be accounted for appropriately. At a minimum, this should be done quarterly for public filers, but we suggest at the beginning, this is actually done monthly so that companies can begin to work through the kinks of how to modify business processes to learn and address these changes in an appropriate timeline.
Yeah, I'll jump in right here and quickly comment on two things. We have observed that it can be difficult to interpret guidance on what constitutes inclusion in your presumed payment schedule to accurately reflect the liability on the lease. So, Todd mentioned index-based payments, CPI as an example. Companies in our engagements have taken somewhat opposing stances on what is considered known escalations. Most have incorporated a benchmark index in the payment schedule. Then only a portion of the payment adjustment would be booked to variable rent with the minimum escalation incorporated within the liability. This seems to be, this seems to best reflect the liability of the lease at inception. If you determine not to incorporate a benchmark into the schedule, then all future escalations would be considered variable. The significance of your interpretation would affect your disclosures, as the difference either sits in the liability or in your variable rent disclosure requirement. Something else to consider here, as actual disbursements are processed through the ERP accounts payable module. They may vary in amount and date paid to the scheduled payment, which will need to be evaluated for reason. Is this, a one-time change, such as a late payment fee or overusage, which will not really affect, successive payments? Or is this a permanent payment change as a result of renegotiated terms of the contract? The reason will indicate the way in which the difference is accounted for, either as variable rent, an entry to post to a balance sheet account, or potentially a modification to the lease.
Yeah, so there's a few tricks that we recommend to clients as they start working through this payment reconciliation process. First is that we recommend that the debit from AP and the credit from the lease accounting system are both coded to a clearing account for easier reconciliation. So that means that the expense entry is fed from the lease accounting system, and the payment through AP is a balance sheet only entry of credit cash and debit lease clearing. Second is that you find a unique identifier that helps you tie the AP payment to the lease in the lease accounting tool. So this could be something like a PO number or a vendor number or something just that allows you to easily match those payments. This becomes more and more critical as the volume of your lease portfolio grows. The third trick is that you can actually pull this reconciliation process out of the close window and reconcile as you go throughout the month. And what I mean by this is that when you load your leases in a leasing tool, whether that's a third-party system or Excel, in order to get the right of use asset and liability, you have to load all the presumed payments throughout the life of the lease. So this allows you to check each month what you're paying and how it compares to what your leasing tool says you're paying. And the important point is that you can do this at the point of payment. So if the invoice is different from what the tool says should be paid, you can immediately investigate and address any issues at that time versus waiting to reconcile during close when things are typically a little more frantic. Pulling this reconciliation process outside the close window is important because some differences may be easier to reconcile, like CPI-based rent escalators on a real estate lease. Under ASC 842, this was likely previously addressed as being unknown and therefore wasn't included in the initial lease liability. However, when it's triggered later in the lease, the difference is accounted for as a variable lease payment. The only thing that needs to be done is that the variable lease payment needs to be recorded somewhere for disclosure reporting purposes, and we'll talk a little bit more later in this webinar about how to do that. But sometimes the reconciliation process isn't that quick. If you investigate the difference and realize the lease was modified or amended, there's additional work to perform if a remeasurement of lease is required. As a brief reminder, if a lease liability changes, either because you modify the contract or there's a change in the expectation of whether or not you plan to exercise an option or buy out the asset, you have to remeasure the lease. This means that you'll likely need to gather the contract and work through the specifics of the change and how that's going to impact the right of use asset and liability currently on your balance sheet. The point being that this is something you don't want to be surprised by on workday 2 if you're trying to close the books. This is something that ideally you manage during the month when you aren't crunched for time. In a similar fashion, every month you'll need to consider end-of-term options for your leases. So many of the leasing tools have notice periods that you can load into the lease, which will help keep track of managing the end-of-term options in a timely manner. So this includes both commercially executing the deal as well as appropriately accounting for the event. So bringing us back around, this is why it's important to think about business workflow, event notification, reconciliation, and other factors before you enter your monthly close window. A couple other factors that you should think about prior to close is updating IBR rates, particularly if you have a large IBR table that's driven by a decentralized treasury function. This could take a little bit of time to update. For companies with international leasing operations, updating foreign currency rates and your lease tracking tool will be a part of your close process, whether this is software tool or Excel, to allow you to remeasure and translate the lease balances. It's particularly important if you're relying on your leasing tool to produce the required disclosures. You'll need to make certain that the reporting currency balances coming from that tool are aligned with the reporting currency balances in your systems. So Neil, can you share what some of our clients are doing around business workflow, both identifying new leases and capturing changes to existing leases?
Right. So Todd's comments really underscore the criticality of understanding the people internally and externally that are connected to the lease, either through deal origination or event management, and the considerable process transformation effort to change existing 840 business and accounting activities to maintain compliance under the new standard. So, our observations of clients who have focused on business transformation as part of their adoption plan have really highlighted key controls throughout their lease management and accounting process. So, consider what your key controls are that will safeguard your leasing activities. So one, how do we maintain the attribute data of the lease? Specifically, any data related to the lease participants, GL segment data, such as the company or department the lease is associated with, or just general descriptors of the lease. This involves establishing policies and procedures for routine attribute maintenance, including, frequency of attestation of specific attributes. So Todd mentioned the breadth of leasing participants involved. The question to ask is how these participants are going to communicate those administrative updates as characteristics or circumstances surrounding the lease inevitably change over time. So two, we also need to track lease events, the business will encounter as part of their normal lease activity. So Todd was also discussing as part of our pre-close activities, various modifications as assets are added or removed from a lease or terms of the agreement have been renegotiated. You can expect that lease administrators will need to coordinate with the business owners that have fiduciary responsibility to review the economics of end-of-term decisions. So timely recordation of midterm and end-of-term decisions to buy, to renew, or terminate avoid the complication of accounting for events outside of the period of activity. And then lastly, how do our decisions get accounted for? The circumstances of the event will drive specific accounting journal entries. The answer would indicate if we are discussing a lease that has been modified, potentially would cause a triggering event, or versus another event that might not cause remeasurement of the asset. To wrap this up, compliance seemed to be a common theme amongst our engagements, while day two processes became less of a priority. The accounting for modifications and recordation of asset events can create significant challenges, especially as your lease portfolio increases in size.
Yeah, so that's a good transition to our next polling question. How many leases do you have in your lease asset portfolio? So just to close on that thought, there's a significant amount of communication and training that needs to involve individuals across the organization. Similar to any other change management project, getting impacted teams involved in the conversation up front to define the objectives and brainstorm possible solutions is hugely important to creating the best solution. Number one, it's going to make it easier on you. It's also going to help identify early exceptions in the process. That is, the 10% of items that don't work like everyone thinks they work because other groups have workarounds that nobody's aware of. And it helps greatly with the buy-in and commitment from impacted groups. So we're going to end the polling question now. It looks like everybody's got the responses in. It looks like we've got actually a large number of participants that have less than 50 leases. So, it's very interesting. So 2 last notes on this thought. First is obvious, don't wait until the end to start having business conversations. Start thinking about workflow after day one, and build your list of people and functions that will be impacted up front. What we found is sometimes there are system changes or new data elements that need to be gathered in other groups, particularly to assist with data matching for the reconciliation process, and these changes take time to push through. For example, with one client, they changed their AP process to begin capturing data to ease the reconciliation efforts, and that took a little bit of time to get organized. So get those conversations going early to try and make your day one successful. The second thought is to think through the entire process, from procurement through modifications through retirement, and think about all functional groups impacted, not just operations, but other financial functioning groups like tax, FP&A, and financial reporting. Neil, can you share quickly about the automated cash flow reporting needs of our large healthcare client that required thought and planning?
Yeah, this seems to be a common exercise at the end of the engagement, that a seemingly separate functional area comes into the mix either through a request for data or a financial need. We encountered a situation where one of our clients automates its statement of cash flows, which required significant planning and redesign of their GL integration. The company had requirements to identify in their lease accounting process the purpose of the transaction, so to account for the addition of leases, retirement, transfers, reclasses, and statistical accounts for capital lease payments. Going back to the drawing board, we had to consider how data coming out of the leasing software could support this business requirement, particularly related to intercompany transfers of assets, as this should have a zero, financial statement impact at the consolidation level. But account balances needed, really to move between business units. One other discussion item to highlight here, as we are wrapping up our day 2 conversation, not only are we focused on the various internal functional areas for the management of events and attributes, but also consider the journal entry postings and the potential need for allocating expenses such as intercompany or interdepartmental entries. So basic financial management concepts have been something of a challenge within our system-related engagements, as we've had to configure methods either within the system or design processes outside of the system to simply push expense for a single lease to various cost centers or departments.
So we tried to emphasize, try to pull as much work outside the closed window as possible, because I've yet to meet a client that says, I have plenty of time and resources to close the books. Even if you can auto-reconcile as you go and build a robust pre-close process, there's still a reasonable level of effort to close under 842, particularly in the first few months where you're getting your feet under you. So moving on to month end, the first place that you should start is by closing your lease accounting system, even if this is Excel. Review account activity and look for things that might need research. For example, review fluxes in the asset and liabilities and make sure that they seem reasonable. Roll forward all the activity and make sure that it appears reasonable. I'd also recommend that you take a long look at any gains and loss activity that hits your P&L related to leases, as this would suggest a modification event. What we've uncovered through our projects is that many times these aren't actual modifications. They're a result of one of a couple of different things. Either people executing lease activity in the system incorrectly. For example, people correcting errors on data that was recorded, and rather than adjusting the lease without financial statement impact, they unknowingly recorded the event as a lease modification. You want to go back and fix that before you record those entries into your general ledger. Or sometimes there's just a bug in the software that needs to be addressed, even in a post-go live state. While these systems have made incredible strides over the last couple of years, This is a new standard with brand new software, so software glitches are just a fact of life at this point. The good news is the compliance-related bugs with these software vendors are given a top priority and they get fixed fairly quickly is what we found. Luckily for private company adopters, which it looks like about half of you are, you've got a little bit of time and the software will be much more mature by the time you reach your transition date. So similar to human errors, if you identify system errors, you want to think about how you can correct those financial statement impacts of the error before you close your lease accounting system. Once you close your lease accounting system, you'll need to post the monthly entries in your general ledger. The biggest challenge, as I mentioned previously, is that most of the lease accounting systems are not fully integrated in the GL. So someone from your team is manually posting journal entries based on activity reports and trial balances that come from these systems. While this should be fairly simple in the long run, what we found is that errors are made in this step in the first few months as people are learning how to operationalize this process. It goes without saying that highly decentralized companies carry more risk where multiple groups, let's say various regions, are responsible for recording activity in the lease accounting software and then posting month-end results to the general ledger. We have a whole hour set aside for addressing the control aspects of adopting the new standard, but I want to make the point here that you need to spend time thinking about controls to ensure the accuracy and completeness of the ending balances in your financial statements. We've seen several clients post journal entries from their lease accounting system into their general ledger, and when we've gone back to help them with the reconciliation process, have identified the balances in the general ledger are not correct. Sometimes the balances were wrong because someone posted the wrong account, and sometimes they're wrong because although the lease was recorded correctly in the lease accounting system, it didn't make its way into the journal entry report to be recorded in the general ledger. So make sure that you spend sufficient time reconciling both the subledger data as well as the final general ledger balances. So let's pause for a second for our last polling question. How does your company intend to handle and maintain the required accounting once ASC 842 has been adopted? A, leverage a module associated with our ERP vendor. B, engage an independent lease accounting software vendor. D, utilize existing desktop applications such as spreadsheets. D, we have not yet determined how we will handle lease accounting. So the final topic we want to cover in this hour is disclosure reporting. So the slide that we're showing now is an overview of the lease disclosures required under ASC 842, and many of you are probably aware of them. If you aren't, we wanted to share them with you. However, we want to steer the conversation back to the point that I made previously regarding business planning and to begin thinking about how you want to gather the required information. This is one of the major selling points of lease accounting software. So if we look, let me end the polling here, and we look, and it looks like you know, about almost 40% are planning on using some sort of system. Another 16% are using a module within their ERP. So that's well over half. And then we've got about a third that are still figuring this out. So you know, that's important as we start to think about disclosures, because again, that's one of the key components of why people are buying systems. So if you're planning on managing your stuff in Excel, that's fine, especially if you've got just a handful of leases. But you need to start thinking about how you can gather and reconcile the data required for disclosures. So most of it's not very difficult if you plan ahead and you have a robust Excel tool, because most of it just feeds directly from the calcs that are coming from your tool. The two that might be a little more challenging are the weighted average calculations for weighted average lease term and weighted average discount rate. However, even people who are using lease accounting systems, we've encountered the need to think through how you're going to capture disclosures for a couple specific items. The first is short-term leases. The standard allows for a short-term lease exception where this is defined as 12 months or less. You're not required to record a right-of-use asset and liability related to those leases. You do, however, need to disclose short-term lease expense, and that is being leases with greater than 1 month and less than 12 months on your quantitative lease disclosures. So clients are faced with the option of whether or not to include these leases in the population to be abstracted and input into the leasing tool. I've had a few clients that still want to put these leases in the tool to maintain completeness and to have a consolidated view of leasing spend, particularly if you're looking to gather business-related metrics, so how much you spend by asset type with various vendors, et cetera. But most of our clients, particularly those with large rental portfolios, are choosing not to put this data in the leasing tool. The time and effort not only put it in on day one, but also the monthly maintenance of ensuring that the portfolio and the system is accurate isn't worth the business insight. They're finding other ways to gather that vendor information. But they do still need to report on those short-term lease costs. And what we're seeing is that clients are opening new accounts and training team members to code the short-term leases to those new GL accounts. Then they pick up the account activity at period end to populate required disclosures. The second required disclosure that clients are occasionally managing outside the system is variable lease payments. These are lease payments that are not part of the capitalized right-of-use asset. A couple of typical examples are payments after year one of a real estate lease that are pegged to changes in CPI. We've talked about this before, that were deemed to be unknown as of the lease inception date. Or it could be CAM charges paid to the lessor if you elected to bundle lease and non-lease components. The standard requires you to disclose variable lease payments within a reporting period. So most systems have a functionality that allows you to make payment adjustments to leases to capture these variable lease payments within the system. And the way you do that is first to identify the differences during the reconciliation process. Again, another good reason to reconcile where you're making the payment to avoid double handling the lease. When you're identifying a variable lease payment, best practice for these systems is to post a payment adjustment to the lease for the variable component of the payment within the system. And when you post it, you choose a reason code that would tell the software that the payment needs to be disclosed on the disclosure report as variable rent. And so by following this practice, all the payments made to the lessor are captured in the lease software, and the disclosures can be sourced completely out of the leasing software. The difficulty with doing this is, besides the work required to reconcile and make the payment, there's a level of effort to manage the workflow within the system to get the variable payment pushed through the leasing software so that it shows up on the disclosures. And so for clients with a small staff and a significant number of leases that have variable payments, so think copiers, for example, with a base hardware lease and then a charge per sheet, they don't view the time and effort to push the variable payments back into the system as being worth the benefit. So instead, similar to short-term leases, these clients are opening GL accounts and coding the variable piece of the lease payment to this GL account and the base lease amount to the lease clearing account to match the assumed payment coming out of the leasing software. Then they add the activity in the variable rent account to their period end disclosures manually. So again, not best practice in terms of utilizing functionality within the leasing software, but we certainly understand the practicality of such an approach and simply encourage them to be sure to have good controls around managing the activity in those accounts and that the integrity of the account is upheld.
Yeah, Todd mentioned a number of ways of aggregating disclosures outside of just a lease accounting system. These are valuable insights as they can significantly make your business and accounting processes more efficient. Or to say another way, reduce the need to redesign a number of accounting processes to claim compliance. As another area of insight on disclosures, from my experience in these engagements, just give consideration for external business arrangements such as joint ventures or VIEs that might add reporting or other disclosure requirements. It might be that the business manages consolidating leases as well as leases that fall under equity method investments. These have to be partitioned from the primary business to account for separately and be reported on within the business arrangement. We can work to design tools or organizational structures in the configuration of systems or the way in which we aggregate Excel data to satisfy these types of requirements.
So the big theme that we're hoping to drive home today is that there's an endless number of ways to manage the interaction between your systems and business processes to successfully operate in a post-842 world. Many of the leasing tools have best practices that they recommend, but we understand that those don't work for every client. In the engagements that we run, we try to work with each client's unique needs to craft a solution that meets their individual requirements and is scalable and repeatable with a level of controls that's appropriate for the situation. So we obviously had a limited amount of time today, so we tried to pick and choose the best advice we had and examples we've seen from our engagements. If you have questions or ideas that we didn't address, we've left a couple minutes at the end for some Q&A. So if you have a question, please click on the Q&A button at the bottom of the screen and type your question. So let's start with the first one. And Neil, I'm going to ask you to comment on this. What kind of integrations are you seeing to ease the efforts of what are typically already short-staffed accounting departments?
Yeah, our first recommendation is to gear your efforts towards compliance. So, to drill that in, start with compliance. For future state, when you're looking at integrations, there's a bunch of, there's ERP integration for your journal entries. So really you're saying to yourself, how do I automate the exchange of journal entries from a system to an ERP, or, do I continue to manually import those transactions? You can also consider an AP integration to reconcile cash payments. Todd mentioned this in our discussion, but you have due payments from, let's say, a system that need to be reconciled against actual disbursements from AP. You can, in thinking through a couple more, foreign currency exchange as well. And then lastly, really, a feed of master data from either the ERP or a contract management tool as well. I mean, all these, can be considered in automating your exchange of data. I think the main point here, though, is, in starting within this process, just make sure the majority of your focus is around compliance.
Okay, thank you. Another question, can you discuss taxes and the impact the new standard will have on company taxes? I guess I'll take this one. I will start by saying I'm not a tax expert, but I'll tell you at least kind of what I understand from talking with our tax teams. The first is there's not an expected material difference on federal income taxes, but that isn't to say there's not an impact on your deferred tax calcs. Obviously, with the balance sheet changing, the calculations of your deferred tax calcs will need to be revisited and make sure that all the support around how you calculate deferred taxes is in line with how the new standard works. Another place where we'd expect to see impacts is potential impacts is state taxes. So state taxes could be affected by the balance sheet gross up in a couple of different ways. The first way is franchise tax calcs are usually based on net worth, and the computation of net worth could change as a result of the new standard. So make sure that you or your tax teams take a look at that. In addition, state apportionment could be impacted. If you have or operate in states that have three-factor apportionment factors that include net assets, you'll need to take a look at that and figure out what the impact is there. A third one is potentially property taxes. With having right-of-use assets on the balance sheet at that point in time, trying to figure out if there's a property tax impact and making sure you look through, the local jurisdiction rules around property taxes and how that's impacted with the grossed up balance sheet. And then the last thing that I want to highlight is potentially transfer pricing for multinational companies. Usually, historically, they use GAAP balance sheet factors as a component for trying to figure out fairness. And with balance sheets changing, companies should reevaluate the impact of transfer pricing, and those transfer pricing calculations based on the changed balance sheet. So Neil, why don't you comment on what are the biggest pitfalls companies encounter in adoption?
Yeah, the biggest thing here is starting the adoption process too late. Simply put, it's just not dedicating enough resources to the effort and making sure you start this process really early. This is really complicated. There's a lot of accounting changes and there's a lot of consideration around business and accounting workflow decisions that you have to make, especially those, transformative activities that you consider as part of this process. And then the second thing I would say, one of the biggest pitfalls is just really the completeness and accuracy of the data abstraction process, confirmed really by your GL reconciliation activities. So, we talked about day one transition, those GL reconciliation activities are just making sure that you have alignment with balance sheet accounts, for your capital leases or, your finance leases under 842, a lot of those balances are carrying forward. But for operating leases, the balance sheet activity is really around the deferred rent. account. So making sure that whatever you're carrying forward to 842 aligns with the accounting that you performed under 840.
Okay, thank you. All right, we're getting another one that says, when you determine the accounting output under 840, what ways are you validating the results when there's no previous balance sheet accounting? Any tips or tricks appreciated? Yeah, so we talked on this a little bit in the presentation, but let's kind of go back to it because I think it's an important point is, you know, it goes back to, you know, kind of comparing P&L pre and post adoption, making sure that, you know, what you've got in there appears to be in line and makes sense. Also making sure that, you know, your balances go away, your 840 balances go away, and that you can make, you know, kind of a rational justification for the balances that are on your balance sheet. So, you know, I would look kind of at the lease level and look at the right of use assets and liabilities that are being created from a lease level and make sure nothing pops out there. All right, let's do one last one. Major lessons learned through public company adoption that could assist private companies who will be adopting. Neil, you have any comments on this?
Yeah, I think we touched on much of this during the webinar as well, but to highlight, you know, the benefits of a system versus Excel are many. You know, the system itself is really going to assist with, you know, midterm and end of term events, both notifications as well as the accounting, and the cost of a system can be reasonable. So it's something that, you know, you should look at, but it's all, you know, just based on the results of the polling. If we're dealing with less than, you know, 50 leases, maybe the system isn't exactly the solution that you're looking for. Next, though, you know, just what we've seen is just the interaction of multiple parties really can be substantial, and this kind of goes back to the business and accounting workflow discussions that we've been having. But it just requires significant planning for, you know, I'll say assessment of your current state processes as well as, you know, consideration around your future state processes. And what's really bridging that is, you know, the transformation of those processes to your future state to be able to maintain that compliance. So I would just highlight those two things, you know, that really can assist the private companies.
Thank you. All right, we'd like to thank everyone for participating today. If you have questions we weren't able to address or questions that come up later as you share all your insight that you gain with your significant other, please don't hesitate to reach out and ask. We'd be happy to have a conversation with you. If you stayed with us for the requisite 50 minutes and answered all the minimum 4 out of 5 polling questions, you're going to receive an email from us with a course evaluation and a link to a CPE certificate. This should arrive in your inbox by the end of next week, so please keep an eye out for it. You might want to look in your spam folder or something like that if you don't see it. As a reminder, part 3 of the webinar series will take place 2 weeks from today at the same time, and we'll be talking about managing data, the collection of it and abstraction of it. So we hope you'll join us again. Again, thanks for joining us and have a good day.